Okay, class, you're on the home stretch. This is chapter 6, part 3 of the lecture, section 5. We're going to go over use an alternative form of contribution margin when faced with a resource constraint. So I kind of referenced this earlier, but what are we going to do if we only have a certain amount of hours of direct labor that we can allocate towards creating these kayaks? And so we have to know and understand whatever our strategy is. So what are resource constraints and what are resource constraints an issue for most companies? So most companies have limited resources in areas such as labor hours, how many people can work, how many people can work, and how many hours can those people work. Machine hours, how many hours can you run the actual machine and have somebody there to run it and watch it. Facilities and materials, right? These are all constraints that all companies have. These constraints often affect a company's ability to produce goods and or provide services. The contribution margin per unit of a constraint is a helpful measure in determining how constrained resources should actually be used. And sometimes you will be surprised how they turn out or what the answer turns out to be. So kayaks for fun. Kayaks for Fun produced two kayak models, River and Sea, as we already know. And based on the information below, Kayaks for Fun prefers to sell more of the River model because it has a higher contribution margin per unit. $400 contribution margin per unit. Hey, I'm all with it from first glance. I say that's what we should do as opposed to produce the C model. But there are other variables at play. So how do managers use the contribution margin per unit of constraint to make decisions? Assume Kayaks for Fun has a total of 320 labor hours available each month. So 320 hours for the month. Assume the river model requires 4 labor hours, so just keep that in the back of your head or write it down. The river model requires 4 labor hours, and the C model requires 1 labor hour per unit. Now, your spidey senses should already be tingling when you look at the fact that it takes 4 hours to make the river model, right? So maybe that is why the contribution margin is higher. And the C model, it only takes an hour to make. So we can probably allocate more labor hours and produce more C models in relation to the river model. So Kayaks for Fun sells everything it produces. Given its labor hour constraints, the companies prefer to maximize the contribution margin per labor hour by selling the C products as shown below, right? So $400 margin per unit divided by 4. Well, where does the 4 come from? The 4 comes from 4 labor hours. And then you have $150 divided by 1. Where does the 1 come from? Well, it only takes an hour to make the C model. So if you take your $400 contribution margin, so how do we know that $400 and $150? We go back to here. That's our contribution margin for each one for the river and the sea, right? So if you take 400 and you divide it by 4, you have $100 contribution margin per labor hour. But on the C, you take 150 and you divide it by 1, and you have $150 contribution margin per labor hour, which leads you to believe that the company is going to say, hey, you know what? If we only have 320 hours, we're going to make the C model. You also have to understand the effect of income taxes on cost volume profit analysis. And this isn't something complex. This is just saying, hey, we want to add in the component and make sure that you think about the fact that companies as well as individuals have to pay taxes. So we want to find out how much we actually want to sell. And this is more reality based in order to make this profit because we know that we're going to be taxed a certain amount. What are the three steps for finding the target profit in units or sales dollars for an organization that pay income taxes? Well, all the steps are the same as before. You're just going to add an extra component in relative to the taxes. So step 1, determine the desired target profit after taxes. Step 2, convert the desired profit after taxes to the target profit before taxes using the following formula. Target profit before taxes, right? So you just change it from target profit to target profits before taxes equals target profit after taxes, right? So our target profit is 30,000 before, or was 30,000 before, it's still 30,000. So we're just going to call it now target profit after taxes, divided by 1 minus the tax rate. So 1, let's say the tax rate is 20%, then it's about divided, or 1 minus 0.20, and then you divide it by that. So step 3, use the target profit before taxes in an appropriate formula described earlier in the chapter to calculate target profit in units or sales dollars, right? So makes sense. All we're doing is just adding this extra tax component in there. So understand how managers use variable costing to make decisions. This is the last topic that we really talk about. You have the difference between variable costing and absorption costing. So what is absorption costing? A costing method that includes all manufacturing costs, fixed and variable, in inventory until the goods are sold, right? So absorption, you're absorbing all of those costs, whether they be fixed or whether they be variable. This method complies with the generally accepted accounting principles. All non-manufacturing costs, selling and administrative costs are treated as period costs and expense in the period incurred. Remember, they refer to those as period costs because they're expense in the actual period that they're incurred. So you have your absorption costing, but what's another way to do it? Maybe you want to try it using variable costing. So what is variable costing? Costing method that includes all variable manufacturing costs and inventory until the goods are sold. So just the variable manufacturing cost and inventory until the goods are sold, as opposed to the variable and the fixed cost. Uh, but reports all fixed manufacturing costs as an expense in the income statement when incurred. So when they are incurred, they are noted as an expense in the income statement. So if you don't have to pay this till the end of the month, then hey, we'll put that on the income statement and pay that fixed cost at the end of the month because it doesn't really have anything to do with our production, right? So for some companies, the variable costing works a lot better. And this is just a comparison between the two, is exactly what we just said. So in absorption costing, you have direct materials, direct labors, variable manufacturing overhead, fixed manufacturing overhead, which is all your product costs, and selling administrative, which is the same on both sides. That's going to be your period costs. Over here, you have direct materials, direct labor, variable manufacturing overhead. But what's missing from the product cost? Well, what's missing is that fixed manufacturing overhead. That's now moved down to this bottom section where it's going to, the cost is going to be incurred in the period. So fixed manufacturing overhead is now going to be incurred in the period just like selling and administrative costs. And that is the difference between absorption costing and variable costing. So what are the advantages of using variable costing? Why do we even bring this up? It provides managers with the information necessary to prepare a contribution margin income statement, which leads to effective CVP analysis. And it prevents managers from increasing production solely for the reason of inflating profits, since fixed production costs are not included in inventory using variable costing. So for a lot of companies, it'll actually help them to get more efficient, more accurate numbers. So that's the end of part 3. I told you it'd be a little bit shorter than part 1 and part 2. Sorry, lecture's a little bit longer, but there were 49 slides. Just had to get through all those components of chapter 6. As always, you'll have your chapter to read, and then you'll also take your quiz and look for any possible homework assignments. As always, have a good day and a great week. Thank you.